Ever found yourself staring at the Newton app, finger hovering over buy, and wondering, market or limit? Which one is the right move for my hard-earned cash? If you have, you're not alone. It's a question that trips up new crypto investors and even seasoned traders on occasion. Today, we're diving deep into the world of order types on Newton, specifically pitting the seemingly simple market order against the more strategic limit order. By the end of this video, you'll not only understand the nuances of each but also have a clearer idea of which one reigns supreme for your specific trading style and goals. Let's set the scene. You've done your research. You've identified a promising cryptocurrency, let's say Ethereum, for argument's sake. The price is looking good, and you're ready to jump in. This is where the fork in the road appears. Newton, like most exchanges, offers you two primary ways to execute your trade, a market order or a limit order. Understanding the fundamental difference between these two is absolutely crucial to getting the best possible price for your crypto and avoiding unnecessary fees or unexpected outcomes. Imagine you're at a bustling marketplace. A market order is like telling the vendor, I want to buy X amount of Ethereum, and I want it now, at whatever the current best available price is. It's about speed and immediate execution. Newton will look for the best available sell orders on its order book and fill your buy order instantly, starting from the lowest available price and working its way up until your entire order is filled. Conversely, if you're selling, a market order means you want to sell your Ethereum now at the best available buy price. The beauty of a market order is its simplicity and immediacy. You click, and your order is filled. There's no waiting, no wondering if your price will be hit. This can be incredibly appealing in fast-moving markets or when you need to enter or exit a position urgently. For example, if there's breaking news that you believe will cause a rapid price increase, a market order ensures you get in before the pump really takes off. Or, if the market is crashing and you need to cut your losses, a market order allows you to exit quickly. However, this speed comes at a potential cost. Because a market order prioritizes execution over price, you might not always get the exact price you see flash on your screen. This is due to something called slippage. Slippage occurs when there isn't enough liquidity at the exact price you intend to trade at. For instance, if you're placing a large buy market order and there aren't enough sellers at the very lowest price, your order will start filling at that lowest price but then move up to the next available price, and the next, until your entire order is completed. This means your average execution price could be higher than what you initially anticipated. Similarly, with a sell market order, your average execution price could be lower. While Newton is generally a highly liquid exchange and volatile or thinly traded assets, slippage can be a real concern. Now, let's contrast this with a limit order. A limit order is like telling the vendor, I want to buy X amount of Ethereum, but only if the price is $Y or lower. Or, if you're selling, I want to sell X amount of Ethereum, but only if the price is $Z or higher. With a limit order, you set your desired price. Your order will only be executed if and when the market price reaches your specified limit price or better. The primary advantage of a limit order is price control. You dictate the maximum price you're willing to pay or the minimum price you're willing to accept. This eliminates the risk of slippage and ensures you get the price you're aiming for. This makes limit orders ideal for strategic trading, for accumulating assets at a specific entry point, or for taking profits at a predetermined exit. For example, let's say Ethereum is currently trading at $3,000, but you believe it will dip to $2,900 before resuming its upward trend. You can place a buy limit order at $2,900. Your order will sit on the order book, waiting. If Ethereum drops to $2,900, your order will be filled. If it never reaches that price, your order simply won't execute. The same applies to selling. If you bought Ethereum at $2,500 and want to take profits when it hits $3,200, you can place a sell limit order at $3,200. The downside of a limit order is that there's no guarantee of execution. The market might never reach your specified price, leaving your order unfilled. This can be frustrating, especially if you're trying to catch a rapidly moving trend. You might miss out on potential gains if the price rockets past your limit order without ever touching it. So, when is each order type best on Newton? When to use a market order? Urgency is key when you absolutely need to enter or exit a position immediately, regardless of minor price fluctuations. Think emergency exits during a sudden crash or quick entries during an unexpected surge. Highly liquid assets, for major cryptocurrencies like Bitcoin and Ethereum on Newton, which typically have deep order books, the impact of slippage on a market order is often minimal, especially for smaller trade sizes. News-driven trading, if you're reacting to breaking news and want to position yourself quickly before the market fully digests the information. New to trading, for beginners, market orders are simpler to understand and execute, reducing the learning curve. However, it's crucial to be aware of slippage even for small trades. When to use a limit order? Price precision is paramount when you have a specific target entry or exit price in mind and are willing to wait for it. This is the hallmark of a disciplined trader. Avoiding slippage, when trading less liquid altcoins or executing large orders, a limit order protects you from unfavorable price execution. Setting strategic entry/exit points, for dollar cost averaging, accumulating at dips, or taking profits at predetermined levels, limit orders are indispensable. Trading during off-peak hours or volatile periods, when the spread between buy and sell prices might be wider, a limit order helps you avoid getting a bad fill. Patient trading, if you're a long-term investor or a swing trader who isn't in a rush to execute, limit orders allow you to set your conditions and wait for the market to come to you. Let's talk about fees on Newton. Newton is known for its competitive pricing, and generally, there isn't a significant difference in maker/taker fees that would drastically swing your decision between a market and limit order for smaller, common trades. However, it's worth understanding the concept. When you place a market order, you are typically considered a taker because you are immediately taking liquidity from the order book. When you place a limit order that doesn't immediately execute, you are typically considered a maker because you are making liquidity available for others to take. Some exchanges offer slightly lower fees for makers to incentivize liquidity provision. While Newton's fee structure is transparent, it's always good practice to check their latest fee schedule for the most up-to-date information. The real cost difference often comes down to the price you get, which is where slippage from market orders can truly impact your overall return. With that said, thanks for watching and until next time.